Okay.
So basically, when you come up with an idea for a startup, the next stage is usually to identify whether there is a right market fit for it. And at
Mm.
our today's session, our expert session, today we are going to dive into what market research and validation means in the startup context. And I'm warmly welcoming our guest speaker, a strategy venture and impact advisor to early stage ventures and corporates, helping teams validate markets, design defensible value propositions, and move from insight to execution in complex B2B environments. George, very, very welcome. Hello to you, and thanks for joining us today.
Thank you so much, Nata. It's great to see you and be on the podcast again.
Yeah, again. So basically, the former session we conducted was quite successful, and a lot of listeners appreciated the insights shared. That's why we are rolling again. And today's meeting is really special, especially for founders of their baby ideas. So, discover what does it mean when you are a startup? And teams often use early interviews to test ISP boundaries, user roles and responsibilities, or, for instance, company size or maybe even compliance maturity and willingness to pay. Cindy Alvarez, in his book Lean Customer Development, argues that basically good discovery interviews focus on what customers do today, kind of how they solve the problem now, what breaks, and what it costs them in time, money, or risk. George, here's a question to you. How do you structure early customer interviews to uncover real pain points of potential customers?
Yeah, I think that's such a good question. I think really you have to be quite deliberate about these interviews, and it's really about learning. It's not about pitching any ideas you might already have. If you're doing kind of early fintech work, you need to really treat custom discovery as a structured research exercise. It's a piece of formal research, and it's not a sales conversation, however advanced you think you might be. So what you can do is you can structure interviews around recent behavior, not necessarily opinions.
Mhm.
And what I often do is I'll ask questions like, walk me through the last time you did X. So maybe a process that you're interested in to make easier,
Mhm.
faster. Or you can ask what might trigger that decision if they're talking about a critical decision. Another example might be, what did you try before and why didn't it work? So you need to really be careful to avoid solution language entirely, and your focus is on the problem. So if someone starts giving feature ideas, that's normally a signal that I've kind of drifted into hypotheticals, which I'd encourage people to avoid. Um, and yeah, because of my research background, what you want to do is pay close attention to emotional markers. So that's things like friction, something that might cause anxiety in a decision process, workarounds, delays. These are often really good indicators of a real problem. Um, that people need help solving. And for regulated spaces like fintech and insurance, you can often also run parallel interviews. So you can interview users, maybe buyers, compliance stakeholders, and if you interview these different stakeholders, you can often then triangulate where there's this genuine pain that overlaps with different stakeholders. So in summary, I think you really need to treat it as a kind of a structured research exercise, and then really dive into the problem without jumping into solutions too early.
Thanks a lot for this insightful conversation. I'd say that, well, it looks like discoveries or early stage interviews allow finding kind of a product market fit, right? Not just investigate whether this idea is worth being implemented. And a well known CB Insights analysis of startup postmortems found that the number one reason for failure in around 42% of cases, if I'm not mistaken, was building a product with no market need. Kind of, your product is good, but thinks we don't need it or we're not interested. And this often happens when teams dive into building before ever confirming that customers actually want the solution. There are a lot of examples of mine when potential customers, they're just looking for investing their money into something before even conducting basic research, right? And unfortunately, in almost 95% of cases, it leads to failures because 5% is kind of it's luck, not the investigation. So to avoid falling into that trap, George, what methods have you used in your experience to validate that a client problem is worth solving before building a product.
Yeah, that's a really, really good point, and it's a problem I see kind of every day, and I often see people who are very passionate and they've got a solution which they've built, spent a lot of time and effort on, but they've really built a solution that's looking for a problem rather than start with the problem first. And also sometimes people might have a solution, but they've built the wrong product. So they might have actually got a solution, but it solves a problem that isn't painful enough to matter,
Mhm.
really. So, before building anything and jumping into solution mode, what you can do is you can look for evidence of costly behavior for your
Mhm.
customers. So that might look like in fintech or in insurance, might look like manual processes or manual workarounds. People might be working from spreadsheets, for example.
Yeah.
Shadow systems, budget leakage. So maybe it looks like that's actually quite an expensive process, especially now tech like AI is mature enough. Unnecessary exposure to risk that might be kind of a yellow flag for regulators. And also something which might be can be described as kind of reputational anxiety. And in fintech specifically, I'll often ask, what happens if this problem, which I think is a problem, isn't solved for the next 12 months? And if the honest answer is it doesn't really matter, then that's a big red flag because sometimes systems are good enough. And what you can also do is use kind of problem only landing pages. You can have pre commitment conversations that are always really valuable. Talking about budget, importantly, maybe conducting a pilot, what the scope of the pilot is, really trying to find an internal sponsor. And then you can have, partner style letters of intent tied to specific operational pain. So often at an early stage, prospective customers will be open to doing a piece of well thought out, structured research that has value regardless of the outcomes. Um, so in venturing roles, this often meant kind of validating process risks and gaps, as well as efficiency gains. And then these tend to be kind of defensible drivers of demand. So yeah, it's a real challenge, and hence why that kind of exploration phase is so important.
Absolutely agree. And here, not only me, before getting prepared for this webinar, I investigated a lot of books, researches, surveys. And one that catched my mind was by Steve Blank's Customer Development Manifesto, who famously reminds founders that there are no facts inside your building, unfortunately. So get outside and test your idea in the real world, especially kind of everyone wants to wonder whether this idea is worth get implemented after asking their moms or dad or families, right? Not inside, go outside. Your customers are over there. And according to this approach, first hypothesis to validate are typically whether the customer's problem is real and whether your product concept can actually solve it. And we already covered this part with you just now. Yet here is a clarification again. George, again, what hypothesis do you typically prioritize first when validating a fintech concept? Because today we are focusing on fintech. This is the domain you are expert at. So let's use it an example, right? There are a lot of hypotheses that might be set, and for sure, they will depend on the
Mm.
product you are trying to suggest to the market, right? And the implementation, I mean, application of this product. Yet, what hypothesis should we set as the first 3 or 5 priorities to be checked?
Yeah, it's a really good question. And if you're kind of examining a pitch, you'll see that founders have thought about this kind of from an investor perspective. And it can sound dramatic, but personally, I like to prioritize hypotheses that might kind of kill the idea really quickly because then it works
Yeah.
out whether it's a good idea or not. So you might have a hypothesis that's like, is this problem real for enough prospective customers? And is it painful enough? So it might be a real problem for you or your friend, but do other people have that problem? Um, and it might be another critical kind of hypothesis is, do prospective buyers have budget and also urgency? So do they have budget and do they have budget now, which you can access? It's all very well having prospective customers, but if they don't have money assigned to pay for it, it actually is really difficult to magic kind of money out of thin air from a budget that might not be there. Um, And then finally, especially with fintech, you need to understand whether your solution or someone that's pitching to you their solution, if you're evaluating it, can that be delivered within regulatory constraints at a viable cost? And the cost bit's really interesting at the moment because tech and AI is suddenly reducing the cost of access to what can historically have been expensive roles. So solicitors, lawyers, tech people, and we're seeing some of the costs that are normally associated with fintechs, which are very expensive, like developers or lawyers, for example, from if there's a regulated space, really come down and become more accessible for founders. So once you've kind of validated or invalidated those critical hypotheses, then you can move into kind of solution desirability or checking the UX of your solution and seeing whether people like it or not. But yeah, for regulated environments, that regulatory veto hypothesis is really important because even if people are really, really enthusiastic, if it's fundamentally kind of in breach of critical compliance elements, that's a real problem and can be very expensive as well for if it's a B2B business, maybe for one of their customers. Yeah, and this mindset really comes from venture work and kind of advising both corporates, but also startups on how they prioritize their portfolios. So you really want to kill weak ideas early, and then direct resources to ones that survive the reality of making it work. And it sounds brutal, but it's less expensive in the long run to ask very difficult, brutal questions. You know, is it a problem that's painful enough for enough people? Do they actually have budget? And is this actually compliant with regulations?
I agree. Just one piece of advice: not to destroy your idea in full after checking this hypothesis, right? And to
Yeah, and
to
yeah. Well, sorry, sorry.
to save this enthusiasm, right? To
Yeah,
work further.
of course, and it's often a perspective, and uh, this isn't. I think it's learning and growing into someone that has confidence in their idea, and you have confidence in your idea because you've spoken to real customers that have that problem and they're willing to pay for it. So I don't mean that in a brutal way, and it's often, this is a limited perspective. People, if they're trying to raise money, tend to have to speak to hundreds of investors, but it is also critical to know that this is a real problem that people are willing to pay for. And if you have that confidence because you've done some great research, then you can push back on a difficult investor or a probing investor and say, actually, we did this great piece of structured research, like we were talking about in the earlier questions. And even though you might have these assumptions, I can show you the data which proves them wrong and shows that this is a viable solution.
I see. I may agree here and also add that basically when it comes to investors and after you validated the stage and you potentially touch the potential product market fit, there is a stage where you need to investigate how many customers could potentially get onboarded on your product, right? Because this is the part where all investors, be them angels, be them venture capitalists, be them, I don't know, grant providers, they will definitely be interested in this. And when it comes to market size, founders often start with big top-down numbers, but unfortunately, investors today want to see realistic, segmented opportunities. And the advice is to, your words, triangulate third-party data, right? Like you mentioned before. And here I read a lot about suggestions of take into consideration some industry reports, maybe even find market guides, maybe to chat with people who are in the market of the domain you're planning to serve with your product. Also have some chit chats, conversations with government stats, right? Plus, go along with your ICP specific research to prove so-called TAM, SAM, and SOM. Basically, those shorts, they mean total addressable market, serviceable available market, and serviceable obtainable market. Those characteristics that any startup should pay attention to, right? Before they go to raise money. George, here's a question to you. From the height, from the height of your experience, how do you estimate those metrics? I mean, TAM, SAM, SOM, and which data sources or proxies do you usually rely on when estimating them?
Yeah, it's a really good question. And a really good point about the source of the data as well, making sure, especially, we often use AI tools to help with a lot of these processes, and it's really important you interrogate the data source if it throws up. If you might be investigating a problem and it throws up some interesting stats, it's really important that you've understand the source and check the credibility of those sources. But yeah, I think this has changed a lot over the last 5 years. And it's become a lot more realistic. And maybe 5 years ago, investors from Silicon Valley wanted incredibly ambitious numbers
Mm,
for TAM, SAM, and SOM, but now it just needs to look realistic and defensible. So I tend to be quite pragmatic about market sizing, and it's a way of helping you make a decision. So I tend to start kind of from the bottom up with a very clearly defined customer segment, really realistic pricing to understand what there is budget for and how much that costs at the moment, and then realistic distribution constraints. And um, yeah, it's really important that you, for those three numbers, unless it's your own specific research and calculations, you understand the source of where those numbers came from. Make sure it's relevant to it's recent and it's relevant to the market you're operating in. So some examples of these might be like if I was had a UK-based fintech, I might say how many UK mid-market firms with um, X regulatory exposure exist, and then what percentage can we realistically reach in 24 to 36 months, and that might be based on some pilot work that you've done or some initial projects, and in terms of the data sources, really needs to be as defensible as possible. And to make it defensible, it needs credibility. So then I'd encourage people to look towards data sources like regulatory registries, like there's the FCA in the UK, industry bodies, uh, transaction volumes, reports, internal benchmarks, maybe from comparable products. Um, and I will kind of personally kind of sanity check those top down numbers. So take a step back and think, does this sound right? Is this actually realistic? Um, but we would just want to know from an investor perspective whether that serviceable, obtainable market is kind of credible and defensible and sounds right. Especially in fintech, where switching costs and trust really matter. So it tends to be quite difficult to get people to change software providers or suppliers, especially if they have legacy systems that are embedded into the way things are done. Um,
mhm.
but it needs to be credible and it needs to sound realistic. And yeah, ideally have sort of evidence to back that up, whether that's your own evidence or evidence from trusted sources. But yeah, be really careful when you're using an LLM to get some stats to support your argument. Just check the source, check where it came from, and put on a different hat of a challenging investor when you might maybe practicing your pitch if you're a founder that's pitching.
Indeed. There is absolutely no way you should rely on an alarm when investigating your market, potential market, because it's always related to the return on investments that you may guarantee. And I
I
don't
think
rely on it because, yeah,
people can tell, I think, as well. And investors have exposed to hundreds of pitches, and you can
yeah.
tell pretty quickly whether someone knows their numbers and whether they're directly familiar with the source or not.
Indeed. So at this stage, it looks like we already found our market size, right? And now we should investigate our competitors. Very interesting and the tastiest part ever in the process. And lean customer dev advice here is to list all alternatives, direct and indirect. And if we take fintech as an example, here, a digital lending startup might position itself as best at servicing unbanked SMEs with embedded KYC. And this is the proof you already mentioned within your speech, and while highlighting why incumbents can't easily match it. And one concrete example here is Tonic. Maybe you heard about them. This is a Philippine digital bank that won its market by being literally the first licensed digital bank in the country. And this regulatory advantage created for them a significant barrier to entry for all the rest competitors in the market or outside the market, and provided a defensible moat. So, George, here's a good question to you related to this competitor research. How do you analyze competitors and identify unique value proposition or maybe so-called unfair advantage that will definitely in the long-term perspective or maybe in a short-term perspective resonate with both regulators and customers, because now to win the market you should really be creative in finding this competitive advantage.
Yeah, I think kind of the word that stands out really is quality. So especially for in fintech and insurtech to an extent. Um, if it's a B2B offering, insurers and financial institutions tend to want to work with credible quality partners. And I think in terms of a defensible advantage for a startup or a scale up, is thinking about why competitors might struggle to copy you. And it might be at an early stage because of energy, it might be because of unique talent that you have,
Mhm,
it might be branding or flair. But normally in fintech, this kind of unfair advantage normally sits kind of in one of four places.
mhm,
Maybe it's regulatory positioning. They might have unique expertise, which understands that better than anyone
mhm,
else. Um, Data access or data rights is a big one, especially in insurtech. Um, Perhaps it's a position in distribution, an embedded position in distribution related to critical workflows that works really well for customers. That's really hard to copy if the customer's using you at a critical stage of
mhm,
workflows and they like you a lot. Um, and also trust and credibility in relation to institutions, which is obviously kind of hard to gain and easy to lose. But you can map your competitors as a startup or a scale up, not just by kind of product and features, but also by customers they serve, risks they might absorb, and kind of incentives they optimize for, which increasingly is can this make me money more effectively or can this make me more efficient? And often kind of the opportunity is serving a segment um, that often incumbents will ignore because it's too small, maybe it's too risky, or maybe it's too difficult. And that's where
mhm,
often the opportunities are for startups and scale ups. But yeah, really strong propositions tend to align kind of real demonstrable customer value, logic, and also kind of business incentives, as I said earlier. Will working with this startup or scale up or using their product help make me more money or save me money directly? I think that's what resonates with buyers, and for regulators, it has to be watertight and bomb-proof, and that comes from testing and proving that it's safe.
I see, George. And here we're talking a lot about regulators, right? And as we know, the fintech domain is super duper regulated. And it especially seen when you try to internationalize your business and try to enter more market, but you cannot because each country suggests its own compliance landscape and framework. So, in a highly regulated industry like fintech, what additional market research steps are needed, in your opinion, just to understand compliance requirements and gain early traction, not just doing some cost devs, but really gaining paying customers?
Yeah, it's a really good question. I think the best way to think about it is that, especially in fintech, compliance is part of the product rather than a constraint. So
Yeah.
you can if you truly understand, what regulatory components are essential, then you can build them into your product, and that can be in a creative way. So that can what I try to do is include early conversations with compliance offers or officers or regulatory advisors. You can also try to understand what approval cycles look like for in certain spaces, and also kind of failure modes, what failure might look like, and understanding kind of where accountability in terms of specific roles actually sits. Um, and one mistake founders can make is treating regulation as kind of binary, like either it's approved or it's not by the regulators. In reality, there's often kind of a gray space where pilots or exemptions or limited scope launches are actually possible if they're designed properly and they're explainable. The FCA has a sandbox, for example, in the UK. And this is an interesting space because investors want to see that founders can be creative and they can hack a system, which might mean finding a way that not necessarily a way around a regulatory constraint, but understanding the regulatory ingredients that apply to a space and being creative about how you kind of apply them. So once you understand that landscape really early by talking to regulators, if you can, they're often open to conversations. That can be a big accelerator because you understand what kind of critical ingredients need to be there, or it can save you from wasting a lot of time and effort and money on a space which does well on a solution that might not have legs or might not be palatable to the regulators.
See, sounds like really wise recommendation to any startup in the world and any domain which exists in the market. Yet sometimes complying with requirements looks easier than answering a question of your early adopters, like how much it costs. Unfortunately, I don't know why. Because here you really need to balance between the value you're delivering and the money your customers are ready to pay for your idea, right? There are no ideas in the market which are charities, right? I mean, when it comes to a business idea, right? That's basically based and launched in order to give money to its founders. So you mentioned a couple of tactics, George, in terms of how you may validate this commercial site, including this POC stage, right? With negotiated kind of price structure and so on. I interviewed a couple of dozen startups last year in 2025. Most valuable tactics they used were using these fake door tests. When they make a landing page with pricing, or if a SaaS product, they add a payment integration requiring a credit card. Kind of, if you want to go next step, add your card. You don't need to pay, just add your card. So psychologically, it allows to see if prospects will actually commit them, if they actually ready to pay, right? And it definitely helps to measure real demand. So here is a good question to you, George. And when testing price sensitivity, what frameworks or maybe experiments you may recommend or have you found most effective in your experience?
Yeah, I completely agree. Nata, it's about kind of testing how committed a customer,
Yeah.
prospective customer is, rather than maybe a preference for your product. And the way you can test that is often ideally through a paid pilot. So we talked earlier about piloting with prospective customers for research projects. Ideally, can you have a paid pilot? Pre-sales as well, we know with a clear delivery scope, so they're happy to commit to a future sale. And another one is a conversation with a key decision maker about internal budget sign off, maybe before you build or refine a solution or tailor it to a specific customer. I think you can also test kind of pricing logic rather than the numbers. And that can come through conversations. Like you might say, is this seen as a cost, insurance, or a revenue enabler? And critical question as well is, which budget does it come from? So you have a really clear understanding of what the budget is for this kind of a solution. So yeah, in fintech, often willingness to pay tends to correlate with risk reduction, and trust is a big element as well, especially in insurance, rather than kind of pure ROI, which is very important. So, pricing experiments need to include that additional element to reflect that framing. So as well as, the value add through enabling growth or improving efficiency internally, actually there might be other metrics that are relevant, like reducing risk or increasing customer trust, especially if it's a fintech solution.
Thanks, George, for this good recommendations, practical recommendations, not just good in theory. Yet it looks like we're moving fast, and smells like our startup already has a couple of paying customers. And imagine at this point we've already successfully made this ABC segmentation. We already find out our ideal clients and what our product market fit is, and we also made a big step in terms of compliances. Right, we investigated a lot here. Here, true product market fit shows in behavior, not just promises. And for example, in fintech terms, this might mean transaction volume growing without additional market spend. Like a high percentage of free users of your product converting to paid, or existing users expanding wallet share. In line with that, high retention and organic growth are often the best or the proof of PMAF, right? Kind of if you are growing your client's base, paying customers base. What else, if not that, may prove that there is product market fit for a product, right? So you don't need any additional confirmations. Yet again, here's a question to an expert in the domain and this in the industry. George, maybe you could share a couple of early indicators, maybe usage metrics on something else related to it. These indicators that you usually look at to determine whether a new product has product market fit. Because sometimes it's not only about kind of whether they pay or not.
Absolutely, yeah. So yeah, I mean, I've got on my notes here, LOIs or letters of intent, which I think are a starting point, but they're definitely not proof, because they're often friends and associates and people in your network. And
Yeah.
actually, investors are increasingly scrutinizing the content of LOIs. If you kind of have maybe you have LOIs listed in the traction slide of a pitch deck. But yeah, I think I tend to look for indicators like usage stats that ideally are growing without prompting. So how many users people have, how many active users people have. Internal champions as well, in terms of customers. If it's a B2B solution, are there people internally that really like it and kind of act as champions for you? And also kind of measurable reductions in manual processes, perhaps. You want for people to really get excited about how it's making their life easier or simpler or more effective. And often if you have these internal champions, these customers will involve other key stakeholders proactively. So they might bring in someone from another team to suggest a refinement to your solution, for example, because they're enjoying using it, but actually they'd love this feature or they'd love this evolution. And I think, yeah, that's a strong signal when customers kind of start defending the product internally or ask for more features or changes. So that tells you it's solving kind of either a politically or an operationally meaningful problem to them. So that's something I look out for, I guess. Ideally, it'd be, and you can reach out to if someone says someone's using this product, or there's a customer here that likes it. It's helpful to talk to them, I guess. That's see how kind of sticky and useful it is.
I see. So nothing to disagree with, to be honest. And sometimes really destruction and paying customers not just depends on kind of your product itself, but rather sales, right? Techniques you utilize and rather the volume and how big your network is to buy your first product or prototype. We've covered a lot about on the topic of hypothesis check, on the topic of compliance. So if you don't mind, let's skip 2 questions related to this hypothesis and balancing integrated feedback. I wish we could go deeper into partnerships, because you've mentioned a very good point related to partnerships with external players. Sometimes those who might be regulators, but also your partners in the long term. Sometimes the right partnership can make you both ABC segmentation and PMF validation. So ABC, when you identify this ICP, real check, right, and proving product market fit validation. For instance, in fintech, how it works. Startup banking partners, right? They can be your partners as well, or processors and data providers. They can be more than distributors and distributing channels. They can really validate your model. They can suggest you their clients' bases, right, through integration of your API to their products and services, which is really useful and convenient for you, but useful for this partner's users. And this really creates a lot of opportunities. I won't tell you exactly which of them. Maybe it's better to approach you with the question, George, what role do banking partners, payment processors, data providers, maybe any additional players in the market, especially in fintech, play in this process of, and the stage of validating a fintech business model when we already made this market validation, but we need to really prove our product market fit. Sometimes it's impossible without having good partners.
Yeah, absolutely. I think it's a really interesting point. And you need to engage partners kind of as early as possible, really with a learning mindset. And yeah, early conversations with a kind of diverse group of stakeholders and partners. Going back to what we said, it should be around, what would break this model, or what would make this kind of unacceptable for you in your business. And asking for feedback from lots of different people early on, which will shape the product and shape the scope. Um, Inform compliance design, maybe your go-to-market strategy. Maybe there's a critical time of year in terms of a sales cycle where things are more relevant or less relevant, um, and as early as possible, really. And this often happens way before kind of formal partnerships make sense. So I think it's difficult. You have to be customer led ultimately, um, and investors don't like you to see you solely concentrating on raising money. They want to see you be truly customer led. So they don't want to see you just wanting to raise money. They don't want to see you stoking your ego as a founder. They want you to be kind of relentlessly focused on delivering directly measurable value for your customers. Um, I think also you can explicitly map, who has pain with your stakeholders, who has power, and who carries risk. So you can run this segmented discovery. And I've done this before where you bring insights together in decision workshops, and this helps surface kind of trade-offs. So the goal isn't consensus with these different stakeholders in a workshop.
Mhm.
It's clarity. I think that approach is really important in fintech, and something that investors like to see documented. And I also apply that in corporate and impact oriented strategy work as well. So uh, engage partners and ecosystems kind of as early as possible. Doesn't necessarily mean that you act on their feedback, but it means they're involved in the conversation, and you can always learn something, I think.
Plus, they also get to know you, right? In these conversations, and maybe could
Absolutely.
also become the part of your future networking through which you can promote, distribute, negotiate, and so on. So, feedback is really valuable at this stage. And this kind of good advice to smart founders, yet besides, should be added that smart founders, they always learn from failure, but wiser ones learn from someone else's. And in startups, this kind of wisdom is a lot cheaper than rebuilding after misstep. So,
Absolutely.
question to you, George. Looking back at your really huge experience, long years of experience, which market validation mistakes should fintech founders, maybe any founders in any domain, avoid? And maybe you could recommend some best practices that may lead you to success.
Absolutely, really good point. And it's easy to look at these and understand them with hindsight. I've made many of these mistakes myself, um, but three big mistakes that founders should avoid really stand out to me. And the first is coming up with an idea, falling in love with a solution before really properly validating the problem. And we talked about this earlier. See lots of people pitching that have solutions looking for problems. That's not what investors or even customers care about. You need to really understand a problem inside out, and then be customer led when you're developing a solution. Um, I think one other mistake that founders make is confusing interest with commitment. And this is why it's such a slog and a difficult challenge being a founder. Lots of people might be interested, but actually committing to pre-sales or a paid pilot or developing a prototype that they pay for is very different to being interested and maybe following the page or contributing somehow. It might be useful, but yeah, confusing interest with commitment is the second one. And then I think finally, and one of the most important ones, especially now, is founders thinking that fundraising should be the priority. It really should be about understanding a problem inside out and generating sales with customers, and some revenue. Um, and I think it can be it's a different time to 10, 15, 20 years ago, where it was easy to raise lots of money for a speculative solution. Now investors tend to analyze startups and scale ups much more like conventional businesses. Um, you know, and fundraising shouldn't be a priority. It should be about uh, developing solutions to genuine customer problems. So, I mean, in terms of best practice, it's really simple, but it's hard to do. So, my advice would be to do fewer things really well, test them very deeply, and try to let evidence, not just enthusiasm, drive decision making. And that's what investors would like to see, that you're evidence led. It's not just a gut feeling that this will be a good idea or this will be a positive addition to a tech solution. Actually, uh, evidence drives how you're developing your product or solution. So, and I think that's kind of a discipline that you get better at and you can learn. And also, what really tends to separate ventures that scale from those that just sound really good on a pitch deck. And at some point, there is that moment where even if you do raise money, you need to generate sales and become profitable. And you can either do that sooner rather than later. And it tends to happen a lot sooner now than it might have done 10 years ago.
Indeed. There is just a few who's ready to give money for another ChatGPT. Why?
So,
So really be ready to fight for the investors' money and prove that your idea deserves implementation. So smells like we've cooked our market research and validation stage today. And George, I'm really thankful. Thanks a lot for your insights and best practices shared. I bet all startup founders who listen to us will send a lot of hearts to your karma.
thank you. Thank you so much, Renata. It's such a pleasure. Yeah, it's always exciting. And I think I think it's a really exciting time for really reasonable, solid founders. Well, really reasonable, solid business cases to be taken seriously by investors in a way where perhaps they might have been interested in moonshot ideas or absolutely hugely disruptive, game-changing solutions. Actually, it's become a lot more measured and a lot more reasonable, which is an opportunity, I think, for founders or prospective founders. And it's a reset that maybe needed to happen in terms of venturing.
Yes, thanks a lot. Thanks a lot for the insights. And I should say that unfortunately, that's all for today. And we wish you more successful partnerships, better product market fits, and faster reach and first paying clients. So bye for now.
Thank you.
Bye.